Hello, Mark Sturdy here with highlights of 7 days ahead's weekly analysis. And if we look to the summary of our positions or our stances, we will see that we remain big bulls of the dollar against the euro in particular and the sterling in particular. Let's just quickly look at the euro. The position here is familiar in the long term. The failure of the market once again after 2018 in 20 and 21 to break up through 125 led to the pullback, the completion of a double-headed head and shoulders reversal, which led to this dive down, strength of the dollar, weakness of the euro. And we see since the beginning of March an attempt by the market to pull back, and basically it's failure once, twice, three times to get back above 111.84. So the market, we remain, is very much still bullish of the dollar, and that's true of the others. Worth pointing out the enormous weakening of the yen against the dollar, or so much so that in fact it's got to the levels of 2015. There would be a natural pause here, I think, which we have experienced in the day chart there, and this is vulnerable to pullback. So this has gone ahead so far, it looks rather oversold, the yen. That's worth making a note. And one other thing, look at sterling euro. Even though the market has failed to break out of the trading range established 2016, there's no tendency to pull back from the edge of it, so that sterling and euro are weakening at the same rate against the dollar, leaving the cross rate unchanged and still close to that 120.81 level, a break above which would be a break of this major trading range. Not there yet, but we're still close to it. Turning to the stocks, the broad story and the summary is we don't think there's a clear position to take. But behind that, if we look at the details, we have, over the last few weeks, a big bounce. So from a position of some jeopardy down at the 4,200 level, for example, the S&P, the market's bounced. And this is true across all markets. The market's bounced best of all in the S&P and the FTSE 100, insofar as they've bounced and broken through levels of resistance where they've failed before. And although it's pausing here, the fact that it broke up through them is impressive. Similarly, we're impressed by the FTSE, whose rally off the wide level of support from these prior highs has been good and has broken the downtrend resistance here. And we can see is in the June contract, very, very close to an all-time high. There's the detail. A break above this would be very impressive indeed. The same is not true of the US Stocks 50, for example, even though the position of great jeopardy here of breaking back down through the support from these 2015, 2017 and 2020 highs was possible, but on the monthly chart it never actually closed there. So a position of great jeopardy has been avoided. However, the rally has certainly taken place, but it's yet to break above the resistance from these prior lows, unlike the US. Worth just mentioning the Nikkei, whose long-term underpinning looks so good relative to the Western markets. The Nikkei's rally has been measured, you might say. It was driven down by the completion of a double top, but it's broken right back through that completion level of 27,000, but has yet to break the downtrend resistance. So measured bounces in the Eurostoxx 50 and the Nikkei, and rather better performances technically in the S&P 500 and the FTSE 100. None of them are a clear buy in our view yet. We'd want the S&P 500 and the FTSE to break the all-time highs that they're so close to, and we'd need the Eurostoxx 50 and the Nikkei 225 to break these downtrend resistances. Turning to bonds, let's look at the summary there. We are, similarly to the stocks, we're not taking strong views overall in terms of each time frame backing up the other. Short term, we're taking a pause in our views. We have been big bulls of yields in the bonds generally, and in particular the US 10-year notes, but it's gone so far so fast and has now come up against a diagonal resistance here. We need a break of that before we get back excitedly on looking for higher yields. Same is true of the, having come so far so fast, this is close to its prior high here, which would be a natural pause in the German Bund. And the gilt, for example, driven by this head and shoulders reversal, pushing up through these two prior lows, it's got to the levels of this levels of 2018, a natural point for pausing. So we are taking a pause in the short term. We're not suggesting that the rise in yields trend is over by any means, but that we might get better levels with at which to buy higher yields. Turning to commodities, the oil is growing in interest for us. We have talked about the natural level for pause being these prior highs, 115 to 110. But increasingly, we're interested in the possibilities of this head and shoulders reversal, suggesting very much higher, up to $150 a barrel. It's already broken, but the market's paused in this rather volatile way, forming a sideways trading range. So there's this pattern here, which we're interested in. We were cautious about calling it before, but increasingly we're interested because we have a congruent or supporting pattern arising from this weekly chart. Now, this is an unusual line, but it's drawn through the highs, and it signaled when the market broke up through that line. It signaled an acceleration in the trend, but since having broken up through it, it's gone sideways and found support from this diagonal. If we look at the detail in the day chart, you'll see that diagonal has not once but twice been good support. It may be forming a triangle. Strong bulls will already want to go long of the oil here, subject to the support from that diagonal. More cautious bulls will wait for a break of that higher upper diagonal, signaling the completion of the continuation triangle, allowing a move up to 150 that we talked about before. So oil is maybe not an out-and-out buy right now, but it's close to a buy as time has gone by and we've formed this pattern here, this possible triangle. Gold we are excited and bullish of in all time frames. The broad picture is of a pause at the 2011 level of 1915 in the June. And the sideways pause has formed a double bottom, we think. And the double bottom broke some weeks ago here. And in the and it shot up to the highs of 2020. The pullback found support exactly where it should have done at the completion level of this double bottom. And if we look at the detail, this is the specific June contract, whereas the other one was a continuation pattern. Finding the market unable to close beneath 1920, which is the completion level of this double bottom here. And in the detail, we can see it's attempted to go lower in the day, but failed. That alone is cause to buy now, we think. And more cautious bulls might want to wait for a break of 1972 before they add on or buy for the first time. That would be a completion of a small double bottom here. So 1972 for cautious bulls, more excited bulls would already want to be long this, we feel. Thanks very much.